The next speaker that I want to bring up is a gentleman that you guys have probably read in the news or saw on television or been to some event in which he was a speaker. But Eldon Rood, I guess I've known Eldon 30 years, probably close to that, maybe close to that. I'm 32. Yeah, I'm much younger than it looks. Eldon is the principal in 360 real estate analysis. So what he does, analytics, what he does is he works with the building community and is able to give the builders some direction about what's going on in the marketplace and where they need to be able to go. And as a 30-year industry expert, Eldon has become one of the region's most respected real estate advisors to professionals in housing, development, banking, commercial real estate, and the government sector. You see his name being quoted in all kinds of newspapers and on television that Eldon said. So, this is what happens when Eldon says it. As a longtime Austin resident, he remains very active in numerous organizations that serve the area, and he has made a life of being able to give back. So, Eldon, we thank you, and come up and tell us what's going on in the builder market.
Okay, good. Whoa. Okay, don't eat dessert yet because you might go to sleep, okay? Ed, Elizabeth, thank you for welcoming out. Regina, thanks for the invitation today to chat with you guys a little bit about some things that I know a little bit about with respect to the economy and the housing market. Dave, after hearing your comments, I suspect that land prices just went up again along 79 between Hutto and Taylor. Maybe they had slowed down a little bit, but that's going to accelerate it for sure. So as Ed mentioned, I've been active in following what's going on in the real estate economy and housing in the region for a long time. Grew up in Houston, went to school here, was lucky enough to find a job when I got out of school. And I worked for a national housing consulting firm for about 20 years and started my own business about 10 years ago. And I work with a number of banks and developers and builders in the region, as Ed talked about, in terms of kind of keeping them updated on what's going on and providing thoughts about what I think is coming. The first thing I'm going to do is kind of a quick, condensed history lesson in terms of what's happened the last couple of years and set the stage for what we might think is going to happen over the next year or so in Central Texas. You guys are certainly on the leading edge of what's happening out there because you're working with buyers and sellers every day. So after my talk, whether it be here or you call me or email me, I'm always happy to learn from you guys, because whether you want to argue with me or tell me I don't know what I'm talking about or confirm some things I'm saying, I learn from you. So a lot of the recon that I do is having discussions with realtors and builders, whether it be sales and marketing, land teams, division presidents, because there's just a lot of information there about what's going on in the marketplace. So it was about 3 years ago, March of 20, when things were really rolling along and everything was going great. And then COVID hit, and for about 6 to 8 weeks, all of us were very concerned that the sky was falling, that the housing market and every real estate component and jobs, et cetera, were about to evaporate. And there was a lot of angst out there, especially among those that kind of track the economy and the housing market. And then within about 6 weeks, the world changed. And all of a sudden, the housing market took off. People began to move to Austin. They could live anywhere, work anywhere, just a flood of in-migration into the region. And you guys' businesses just took off. None of us expected that. If any of you expected that or knew that was going to happen, please raise your hand. Okay, so now it's completely, it's absolute that no one did. And so what happened over the next 18 months was like none of us had ever seen in terms of the amount of people moving here. And what it did was put just extreme pressure on the supply of housing that was available, whether it be resale or apartments and new homes. And so the builders reacted to that as well as they could, and they started a lot of houses, and they started selling a lot of houses. And things were great until about this time last year. And suddenly interest rates had gone up 350 basis points, prices had gone up 75%, and buyers hit the exits, and the market quieted. And so we all kind of lived through that experience. And so as we entered 2023, or I guess really more like November, December of 2022, the builders had a lot of houses that were under construction, and it was a record number of houses. And because of supply chain, it was taking forever to finish those houses, and they were costing more and more. And so there was a lot of angst in the builder community about what are we going to do with all this inventory. People were backing out of contracts, they wanted to renegotiate. And everybody was very cautiously, maybe optimistic is a strong word, as we got towards the end of the year. And then we get into December, things get a little bit better. January, they get better. So sales overall for the builders, January, February, March, April, first part of May, generally have exceeded everyone's expectations for what they thought they were going to do, partly because they were being conservative. So as we sit here today, the builders have now either repriced or finished a lot of that inventory, and things are certainly much more sound. That doesn't mean, as an analyst, I don't get concerned and cautious about things that might happen that would be unexpected, and I'll talk a little bit more about that as I move through my program. So, recap of the last 2 years, did that, the economy, I'll talk about that real briefly, talk about our housing markets, and then kind of moving deeper into 2023. So let's start off kind of big picture. You know, why is there demand for housing? There's demand for housing, especially in this region, because people move here to take jobs, families are growing, and there's certain things that have to kind of be in place to create demand for housing. Part of it is just people, and part of it's the financing opportunities associated with people being able to buy houses and interest rates. So, is your graph yellow or white? Yellow. Okay, hopefully you can see all this. So, typically when I give talks to my clients and others about the housing market, I go on for an hour, hour and a half. I'm not going to do that today. I'm going to make it a lot shorter, and hopefully kind of hit some of the high points that I think are most critical. So first off, we all know that inflation is higher than it's been in a long time. This graph goes back to 2003. The reality is you have to go back to the 1980s when we had inflation that was this high. And obviously that had a big impact on interest rates going from 2.8% to 6.8% and 7% last year. And the Fed has a mandate, a job, to bring the inflation rate down. And so part of the way they're doing that is increasing short-term rates, which is impacting mortgage rates. The challenge for the Fed is employment is still strong, unemployment is low, inflation is high, wages are still going up. And so the only tool they have is a bat, and that's raising short-term interest rates. And so the big question for all of us following what's going on with interest rates is, will the Fed be able to maneuver this path, if you will, to get inflation down to 2%, which is the target, get unemployment to 5%, which is the target, without pulling us into a recession? And I'm not here to answer yes or no whether that's going to happen, but it's certainly going to be interesting to watch. Because some of the experts would certainly say if we're going to get to those levels of employment and inflation, that's going to create some angst in the job market nationwide, and we'll all feel that in housing. So that's going to be interesting to watch. Rates, I mean, this draft goes back to 73. I know some of you probably weren't alive in 1973. But the reason I show a graph that goes back this far is a couple reasons. Primarily to show you that the increase that we saw in mortgage interest rates last year and how quickly that happened has not happened since the 70s. I mean, it was historic and epic in terms of how fast rates went up, and that's why the market reacted so quickly in terms of slowing. If I condense this graph, or maybe expand it's the right word, to just show the last few years, what you would see is that the reality is suddenly, if you will, the last 6 months rates have been between 6 and 7%. So we found an area or a point where we've had some stability, which I think has a lot to do with buyers coming back to the market, and the fact that the builders especially have been able to have more comfort in that and being able to offer forward commitments and buy down rates, so people buying now can get in at 4.9 or 5%. But there wasn't the confidence there among the builders late last year that they could do that because rates were so volatile at that time. So that's been really important. It doesn't show on this graph. Quick history lesson in terms of the Fed increasing rates and what that does to housing production in the U.S. This graph goes back to '83, and you can see some areas that I highlighted. And the reason I highlighted those were periods where the Fed increased rates fairly sharply, and then after that, housing starts went down. And up until a couple months ago, you couldn't see on the far right edge of that graph any impact on housing starts. But now you can see in the graph, rates went up pretty sharply, housing starts came down. That will not be as true in some markets over the next 6 or 9 months, including Austin, but a lot of markets across the country will continue to decelerate in terms of their start space. Our annual rate will go down because we're replacing a year ago starts with current ones, which are lower. But just the reality is that the Fed has this tool at their disposal of raising rates, and it impacts the economy, and obviously it impacts our business as well. So that relationship continues to hold true. You know, Dave said a lot about the regional economy. I wish, Dave, that every time I gave a talk about housing, I'd have you up here first, because you do a much better job than I do of talking about it. But suffice it to say that the Austin region, even in the face of what went down in the first 5 or 6 months of COVID and how many jobs we lost, has been a superstar among large metropolitan areas across the country in terms of job growth. It's just phenomenal. I think I'm only going to show you one graph here in a couple charts. So basically what this graph shows is total non-agricultural employment in the Austin region going back to 2013. And you can see in March of 20, we lost a lot of jobs, a lot of those in leisure and hospitality and education and health services. We lost well over 100,000 jobs. But you can see that we've regained all those jobs plus some. And I think this next chart shows that number. Actually, let's see. Nope, doesn't. But what I'm going to tell you is that there's another chart that basically shows the number of jobs recovered in Austin relative to where we stood before COVID. And Austin is the #1 metropolitan area in the U.S. in terms of how many more jobs we have now than we had pre-COVID. I think it's 160,000 or something like that. More jobs in the region than we had in February of 20. This graph, or this chart, shows the top job markets in the U.S. the last 12 months. And you can see Austin there at #2, 5.2%, 64,000 jobs created in the last year. I will tell you that historically, the last 10 years or so, if Austin was creating 30,000 jobs a year, which was about 3%, that's a really strong year. 60,000 is phenomenal. And obviously, it's important what kind of jobs you're creating. I've had to kind of be honest with my clients as I've started my meetings with all my builder customers over the last days and the weeks to come. I suspected that when the revisions came out to the job numbers, the Workforce Commission revises the annual numbers every March, that the revisions would show that actually we created a lot fewer jobs than we did in the region. But when the revisions came in March for 2022, they actually revised it up. So I was surprised, and the number of professional and business jobs we're creating is still really, really strong. I think it's 17,000 in the region in the last year. A good year is 5,000 to 10,000. So we all know that there's layoffs in the tech sector. I mean, it's happening. We're seeing the announcements. It's hard to tell how many of those are in Austin, but certainly some of them are. But obviously, a lot of those people are getting reemployed. There was an interesting piece in the Wall Street Journal this morning that I'm not sure what the sample size was, but their survey showed that over 90% of the tech employees that had been laid off got new jobs. And they aren't going to work in the service industry, they're going back to work for technology companies. So I think that's a lot of what's going on in Austin, and that's one of the reasons that the housing market has remained pretty strong the first 4 or 5 months of this year, even with some announced layoffs in terms of the tech sector. All right, so a couple quick comments about our housing market. Again, it's not my job to be a cheerleader for the economy or the housing market or for Santa Rita Ranch. It'd be good, and I'm going to do that, Ed, I promise. So my job is to kind of call it like I see it, and so I looked at I look at various variables in terms of the economy and the housing market and kind of put them in a check of it's a headwind or a tailwind. All of you know that rents for apartments in Austin have been increasing significantly over the last number of years. This graph goes back to 2013, so the last 10 years. That red line is overall average rents in the region. All of you also know that during COVID, after the explosion of in-migration, a lot of people moved here. They moved into apartments first. We didn't have enough apartments for them, and so rents went up significantly. And obviously that was a boom for the housing market because people were seeing their rents go up so much. Rates were 2.8. It just made an easy transition into the housing market. The apartment market's going to change a little bit over the next 3, 6, or 9 months. And the reason is that in-migration has certainly slowed into the region, even though job numbers are strong. We're building a lot of apartments in the region, but we're not absorbing them like we were for several years there. I'm going to have to go back to, I'll just have to remember this. So we have 50,000 plus apartments under construction in the Austin region. That's a record. We are delivering somewhere between 10 and 12,000 units a year of apartments. So the ideal for apartment developer and their banker is if you absorb 10,000, if you build 10,000, you rent 10,000. And that's what was going on for a while. But last year, the absorption numbers began to slow. So in the first half of the year, we absorbed almost 5,000 units. And the last half of last year, we absorbed less than 1,000. So that's the entire region. So the math shows that we're absorbing less than we're adding. So what happens is apartment owners and developers say, we need to keep our occupancy up. We're going to start dropping our rents, and we're going to start offering concessions. And so that's what we're going to see in the market the next 3, 9, 12 months. And so that creates a little bit more of a tailwind for housing because people might be more likely to say, well, gosh, not only can I stay in my apartment, I might be able to move into that one that's brand new at a lower rent than I'm paying now. So that'll be a little headwind for housing as we move forward. It'll correct itself over time because we're creating so many jobs, but that's going to be a challenge to some extent. All right, on the new home market side. So I'm going to show a couple graphs that kind of explain what I talked about in the first 5 minutes in terms of what happened during the COVID period and where we are now. So this first graph basically shows, we do a sales and traffic survey among a lot of the top builders in the region, and we ask them every month, how many sales offices do you have? How much traffic did you have? How many gross sales did you have? How many net sales? How much inventory is under construction and finished? This graph shows net sales. So I'll take your eyes to 2020, the red line. So things started off really good, and then COVID hit, and boom, sales went down significantly for a couple of months, and then obviously in May and June of 2020, they just took off. And so you look to 2021, the blue line, and 2022, those numbers started a little bit slower because the builders didn't have the capacity to start enough houses. There was just so much demand. They were pulling back on starts just to maintain their processes, if you will. And then obviously in 2022, May and June of last year is when the market softened considerably. Rates had gone up 300 basis points. Everybody got scared. They pulled back. Everybody said, okay, let's just wait for a deal because prices are going to go down. And then we get to December of 22, sales start to go up. And then you look at the numbers for 2023, the blue line, pretty good sales the last couple of months. Not what we were doing a couple of years ago, but generally pretty strong in terms of the builders. Cancellation rate. So as you guys know, if you look at this graph for 2022, that green line, no surprise, when the market softened, the cancellation rates went up significantly. But you can see over the last couple of months as we started this year, January, February, March, the number on the cancellation rates is not much different than it was several years back. And every builder has a different normal cancellation rate. Generally, the builders that are building in the entry level are going to have a little bit higher cancellation rate because their buyers are generally, there's more challenge qualifying them, and the upper price tier builders are going to have lower cancellation rates. This is kind of a grouping of all of them. So this is really good news for the builders because it gives them a little bit more leverage, which you're probably finding as you take clients into subdivisions, that there's a little bit less opportunity there for negotiation than there was 3, 4, 5, or 6 months ago. Finished specs. So these are homes that are finished and waiting for a buyer. And you can go back to 2021 and the first part of 22, and there were none. I mean, as you guys know, you drive into a subdivision to take a client and say, okay, we'd like to look at some finished inventory, and the builder say, we have none. You want to bid on our next group of specs that we're going to build, or homes that we're going to build. And then obviously, as the market changed last year, in the green line, we began to finish some of those houses that we were building and taking so long, and so now we end up with more finished vacant inventory than we've had in some time. The good news for the builders in the market, I would suggest in general, is that builders that have homes that are either near completion or finished, they're buyers for those houses. They have to do a little bit of negotiating. Obviously, there's a lot of forward commitments going on out there and working with interest rates, but generally they're moving that inventory. That said, this will be an interesting variable for us to watch as analysts as we move through the next 3, 5, 6, 7 months, because we don't want to see that get too high, because that puts the market a little bit out of balance in terms of how much supply relative to demand. Homes under construction. So as I talked about, I mean, the builders were racing to try to start more houses in late 20 and all of 21 and early 22. We had more homes under construction than ever in the Austin region during most of 2021. But as you guys know, and you can see when you drive subdivisions, not necessarily Santa Rita Ranch, but as you drive subdivisions in the region, as I drive subdivisions in the region, the builders are starting fewer houses, and certainly started a lot fewer in October, November, and December of last year. So we need to work this under construction number down. So there's still a lot of backlog, but the builders are working through it. A couple of just kind of big comments, big picture. I'll probably touch on some of these. Strong sales so far this year. A lot of buyers are coming back to the market. We're not seeing certainly as many reloads as we were in 20 and 21, but a lot of buyers that left the market last summer are coming back. While most all submarkets perform well, some required a little more concessions and price work and incentives than others. I will tell you that, and not because I'm here with you, Ed, that the northern market, so Hutto, Georgetown West, Liberty Hill, Leander, generally the stronger markets in the region overall. The markets to the south and southeast, a little bit weaker because there's more first time there, and there was more people that were not able to qualify under new pricing and new interest rates. But generally, all of them are performing well, but some are performing better than others. Again, the cancellation rates have fallen to near pre-COVID levels. And buyers, from what I understand and talking to you guys in sales and marketing people, they want a home quick. They don't want to wait and a house in terms of and expose themselves to that interest rate risk, or get into a situation like it was the last couple of years where someone tells them, we'll have that home for you in 7 months, and 14 months later, they're in that house. So they're looking for homes that they can move into quickly and that they can secure financing and move into. And the good thing is that we have those houses in inventory nearing completion, so that's a good thing. A couple more comments. It's interesting. In my conversations with the builders last October, November, December, when I asked them about what was the strongest motivator in terms of being able to sell homes, it was all about price. And price was the big motivator. And now when I ask that question, the prices have stabilized more, a little bit of concession going on. It's all about affordability and payment. So it's all about rate and payment now. And the builders especially are prepared to be able to do that, to buy down rates. Sub 6 seems to be a critical to the buyers and forward commitments. 7% was not good for selling houses. Neither is 6.9, but something in the 5s and especially in the 4s obviously makes it much more agreeable, if you will, to the buyer community. And now rates have been below 7% for 6 months. I know that's high, but from what I can gather talking to my friends in the industry, buyers have kind of begun to go, okay, this is kind of the new normal. Rates aren't going to be 3%, again, at least in my horizon to buy, so there's a little bit more acceptance of that higher rate. Ed, what was the interest rate on your first house you bought?
15 and 7/8.
Yeah. I didn't tell him I was going to ask that question. 15 and 7/8. Why'd you buy that house?
Because I had to.
Because you had to. You had kids, you had a job, and prices were going up, and you had a job, right? Yeah. So my wife and I, our first house was 7 and 7/8, and I was really mad about that last 1/8, you know. But people will buy houses at higher rates if they're confident about their job, and if they're confident about their home appreciating, and their friends are buying also. It's so much about confidence, as you guys know. Another interesting thing about the climate right now is the resale market can't compete on rate. I mean, so the new home market has provided a conduit for buyers that they go to the resale market, and that reseller, if you go to buy that house, you're going to be in at anywhere from 6 to 6.8%, whereas the builder can buy that rate down to somewhere in the 5s. And also, as we were talking about, I forgot the percentage, but there's a huge percentage of people, probably many of you in this room, that on your home you have a mortgage rate that's less than 3%. So if you're going to buy something else, why are you going to trade out to 6.5 unless there's a compelling reason to do that? So that's certainly keeping people in their homes on the resale side, and that wasn't true a couple years ago. Again, a lot of people sub 3-point rates, and builders have inventory now. Again, reload traffic is not what it was a couple years ago, and it's slowed. Most of the people that we're seeing, it appears to be buyers coming back to the market. There is some reload traffic, but not what we were experiencing before. The resale market, these statistics came out the other day. I'm kind of repeating what I just said. Sales going down in the resale market, not a big level of inventory. People don't have a compelling reason to sell right now, partly because of price, partly because the interest rate they're in, and then people don't have a compelling reason to buy resale because of the interest rate trade-off and what they can get in a new home. Home pricing, this is probably, in addition to kind of some economic variables in terms of job growth and immigration, this is one of the things that I look at is what was turning into a real negative for Austin in terms of our attractiveness to people that are looking to move from other markets is how prices went just crazy during that 2-year period. So this is a graph from Austin Board of Realtors that shows the distribution by percentage of sales by price range over the last 10 years. And during the COVID run, pretty much everything below 300 went away. And as you guys know, if you look at this graph and you know in your businesses, all the growth was above $400,000. And it wasn't sustainable, and it wasn't really healthy, and it put us in an increasingly economic disadvantage with some of the cities that we compete with on economic development front. This is a look at pricing, median pricing. This came out the other day from the National Association of Realtors. For Austin, the major Texas markets, some of the markets we compete with on the economic development front, Atlanta, Nashville, Raleigh, Denver, Portland, Seattle. And you can see the magnitude of the price increases in Austin in the last couple of years relative to the other Texas markets and some of those other Southeast markets. And so the term of Austin being affordable, which was kind of one of those things we talked about a lot over the years, certainly wasn't true the last couple of years. Has moved a little bit that direction over the last 6 months. My expectation is that we'll continue to see overall price declines probably through the next 3-6 months because we need to get back into kind of a balance of affordability relative to what rents are and what payment is. And so certainly some of the builders are moving that way in terms of offering some products that are a little bit lower price points than they were 2 years ago. Some final thoughts. You know, I'm always going to start and end with what's going to happen to the larger economy in terms of the global and U.S. You know, what's going to happen with rates, the debt crisis. I mean, let's hope in the next 10 days they figure it out in Washington and we don't really put the scare into consumers in terms of what might happen then. You know, are we going to move into recession? If we do, what's going to be the impact on jobs? Because if that happens, we're going to feel that in Austin. And that all really funnels down to consumer confidence. I mean, people have to feel confident when they buy a house about their jobs and the condition of the economy and the houses that they purchase. The historic backlog numbers of homes under construction is working its way down. It won't be too long before you drive into subdivisions that you know, months before you could go into the sales office and say, okay, you know, I want a deal. Because the backlog's not going to be there. And so the builder will again have more leverage in terms of those decisions. It's going to be interesting to see what builder strategies are moving forward. I could get into a very long discussion about the division between the public builder groups versus the private builder groups. That's probably not something you're interested in hearing, but call me and we can talk about it because that will change the market a little bit the next 6 months or so because public builders have a little bit more attractive capital financing than private builders that go to banks. And you guys know what interest rates are at banks now. Will the pool of buyers remain strong? I mean, that's going to be a big question for us, and that's tied to that first thing. One of the questions I have for the market is, okay, we're seeing all these people come back to the market, but we're not seeing quite the level of immigration that we were, so how many are going to be behind this surge that we've seen in January through May? So I hope it's the same as it was January through May. I just don't know, but it's going to be interesting to see. And again, our pricing vis-a-vis some of our competitive markets. So the last thing I'll say, and this is not a plug for Santa Rita Ranch, but I know it would. I do business with a lot of builders, a lot of developers and banks, and I've seen a lot of projects over the years in terms of communities and master plans and some that aren't so master planned. And usually they begin with a spreadsheet, meaning I'm looking for a piece of land that we can buy, that we can sell houses at this price and at this margin, and we can get through it next number of years. And so there are not that many communities that start with a piece of land. And so that's what's cool about what you guys have done, and you're not the only one. Others have done it over the years and here in other markets, is to have a piece of land and go, okay, what are we going to do with this piece of land that we're going to own and be marketing for the next 10, 20, 15, whatever, a long time, to be good stewards of it and create a place where people want to come and live and hang out, and you guys are doing that, so that's very cool. So that all said, thank you guys for your time today. Thank you, Ed, Elizabeth, for the invitation. I'm available afterwards. You can always call or email me or find me. You can't find me on social media. My wife won't let me do that, but anyway, so thank y'all.